Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Steve Schoffstall, who's the Director of ETF Product Management at Sprott Asset Management. Steve, great to have you on the show.
Great to be here. Thank you.
Absolutely. So, Steve, we saw this enormous run up in uranium prices back in 2023, but ever since then, prices have been grinding lower ever so slowly. What's going on right now in the uranium market?
Yeah, there's actually a lot going on in the market at the moment. As you mentioned, 2023 was a great year in terms of performance and I'd say acceptance of nuclear energy. Early in 2024, we actually hit a price of physical uranium over $100. We've since seen it pull back where it spent most of 2024, I'd say in that $80 to $90 range before pulling back around $70 at the end of the year. The interesting thing about the market is, though, it's really grown in acceptance, uranium, nuclear energy, over the last 5 or 6 years or so. We're seeing a lot of investor capital come into the space. If you look at the underlying mining equities of uranium, we've seen over the last 5 years or so, we've seen the aggregate market cap go from about $15 billion up over $50 billion where we sit here in early January. So a lot of investor sentiment coming into the space, and that's largely driven by a bullish market that we see going out into the foreseeable future. As it relates to not only what we're seeing from the demand side of things, but also from a supply perspective. There's a number of challenges that we have to contend with over the coming decades as it relates to things like the transition to cleaner energy sources, as well as AI and what that means for energy consumption. What it really comes down to, though, is electricity. We need a lot more electricity just to meet our current demands, but as we start to have technological advances, like AI, like electric vehicles that have to connect to the grid, that is putting a strain on electricity supply. If you were to look at the last decade or so, the electricity demand in the United States was relatively flat. That's largely driven by efficiencies that we've had in various aspects of our economy. We're actually starting to see now electricity demand, not only on a global basis, but in the United States is actually moving higher. All of these are causing governments and even private enterprises to start to look toward nuclear energy as a way to providing reliable baseload power that can help fuel that growing engine that we see from a global perspective. And that's where we're really starting to see a lot of this growth come in as it gets more mainstream acceptance over the last couple of years.
Yeah, Steve, I've been hearing a lot about a renaissance in nuclear energy, and I've been hearing about how AI data center demand is going to drive this huge increase in electricity demand. Can you talk about how those things translate into higher demand for uranium?
Yeah, absolutely. So if you look at AI, if we went back 12 months or so ago, it would be a vastly different story than I think what we've seen to start to really rear its head over the last 6 months is, and what we might be lining up for is that type of generational infrastructure build out that we saw similar, 25 or 30 years ago as the internet really started to require an infrastructure build out. We may be seeing something similar in AI as we head into the next few years and next decade here. According to a recent PwC research piece they put out, they're expecting that by 2030, that on a global basis, AI could be contributing about $15.7 trillion to global economies. So it's a very significant growth that we're seeing, but we're still in the very early stages of the artificial intelligence movement. If you look at some estimates from Morgan Stanley from back in December, they're expecting the largest tech companies, the largest 4 or 5 tech companies, to spend about $300 billion just in 2025 alone to build out the infrastructure needed for artificial intelligence. And even more recently than that, if December's not recent enough, just as we started 2025, Microsoft announced an expected $80 billion capital expenditure to invest in AI just for this year alone. Amazon, just within the last few days, announced $11 billion spend to expand their cloud computing and AI data centers in Georgia so that they can take that increased volume and workload and be prepared for that. And just within the last day or two, President-elect Trump actually announced a foreign investment in artificial intelligence in the United States of about $20 billion. So these are all just headlines over the last couple of days that shows the urgency not only from the United States to be a leader in the artificial intelligence space, but also from the tech companies realizing that this is something that's going to require massive build out. And if you think of these large firms like Google and Amazon and Meta and others, they generally are sitting on very large cash stockpiles. So they do have, the dry powder to go in and make these investments that they see. And so the next logical question is, okay, well, what does AI have to do with nuclear energy, and what's that mean for uranium? So if you look at the data center for the required electricity from data centers, there's an expected tailwind that we're seeing as it pertains to the expected growth in electricity demand as we go throughout the rest of this decade. If you were to look at about back in 2022, about 2.5% or so of the electricity consumed in the United States was related to data centers. Those are more like the cloud storage type data centers. Now that we're going to seeing a rise in the more energy intensive AI data centers, some estimates have that 2.5% of electricity demand in the US growing up to about 7.5% by the end of the decade. So what that means is these larger data centers that are expected to be built oftentimes can require the amount of electricity that's needed to power a small city in some cases. And so what these larger tech companies are finding out is as they expand their AI ambitions and start building these data centers, they really have to find a very reliable source of baseload power. At the same time, they also generally have clean energy mandates. So typically they would look at things like wind and solar and hydro and other renewable forms of energy. But what they're finding with how power intensive these applications are, those types of cleaner forms of energy aren't going to give the electricity and that reliable baseload power that they need. So they're starting to increasingly turn toward nuclear energy as a way to power these data centers. And just within the last 6 months or so, 6 months to a year, you start to see announcements from Amazon buying a data warehouse adjacent to a nuclear power plant in northern Pennsylvania. We saw Microsoft within the last 3 or 4 months is working with Constellation Energy to get the 3 Mile Island nuclear power plant up and running, largely to help power data centers. Bill Gates has invested money in his TerraPower startup so that they can invest in small modular reactors, which are next generation type nuclear reactors, which generally have a smaller output, but they're much more adaptable as to how they can be built and how quickly they can move. So we're seeing all of these moves by these tech companies as they're looking to get more and more invested in nuclear energy so that they can power these data centers. And that all filters back down to the uranium miners. So we can't have nuclear energy without uranium miners, and that's where they're starting to see the increased attention that we're seeing.
And I certainly want to ask you about the uranium miners in a second, Steve. But before we go there, you talked about the demand story, certainly sounds very strong. How about the supply side? Can uranium supply keep up with demand over the next several years?
And that's really the big question and the touchy part of this. So while we have the artificial intelligence aspect, we do have the energy transition aspect of this as well, which is another fueling part of the demand. So where we're at now with uranium, if you were to look back, the last 10 or 15 years or so, much of the 2010s was a period where we didn't really invest not only in mining, but particularly in uranium mining. At that time, utilities were able to largely live off secondary stockpiles of uranium. If you look now where we're at here as we start 2025, most of those stockpiles have been drawn down to a level where they're not meaningfully contributing to the supply of uranium coming onto the market. So we're at a spot now where we start to look out through the end of next decade, out to 2040 or so, and for the foreseeable future, where demand is not expected to keep up with the supply is not expected to keep up with the expected demand of uranium. And that issue is really twofold. So one, we have a permitting process as it relates to mines and building, uranium mines, where it's a very onerous process and takes, a dozen to 15 years or so to get a new mine up and running from, greenfield product up to production. So that's one aspect of it. And we did see recently that the chairman of the Nuclear Regulatory Committee actually came out and said he wants to expedite what we're seeing from the approval process as it relates to nuclear energy and building new reactors. We would expect to see something similar on the mine side as well to keep up with that demand that's coming down the road. So what we see, as we go out through the end of 2040, depending on which projection you look at, they all show an expected deficit in the supply of uranium. Uh, the differences tend to be, to how much of a degree, but what we're really seeing is somewhere between that 1 billion to 2 billion cumulative deficit for the next 15 years or so in uranium. And that's really a spot where the miners have to ramp up production. They have to open up mines that were put in care and maintenance so that they can meet that shortfall. The issue is uranium prices are really at a point where they're not quite high enough to really support the capital expenditure needed by these miners. So we're seeing, in many cases, these miners are a little hesitant to start production or really invest significantly in that space until we can get those prices at a higher point for long enough that really justifies that expenditure. So as we go out through the next, 2 decades or so, we're expecting to see, more mines come operational as the price increases, and hopefully that'll help shrink that supply and demand gap.
How can people invest in this theme, Steve? You mentioned uranium miners. Is that the best way? I know Sprott also has a fund that I think invests directly in uranium. Is that a good option?
Yeah, so in Canada, we do have a physical uranium trust that's listed in Canada and available there, trades OTC in the United States. But for most investors, what we're hearing is the uranium miner space tends to be a place that they're gravitating towards. And one of the reasons for that is it gives you that equity exposure that you don't get with the spot price. So there is a degree of leverage that you get just from owning the equities. So typically what we see in the uranium space and other commodities as well is given the operating leverage that's inherent in equities, we do see that the miners tend to outperform in rising markets, although they'll underperform in decreasing markets. But for investors that have a longer term view on the uranium and nuclear investment theme, we're seeing a lot of investors really take to the equity side, so the uranium miners. We do have two offerings in that space listed in the United States. We have the Sprott Uranium Miners ETF, which is ticker URNM. That invests kind of across market capitalizations. It also includes about a 17 to 18% allocation to physical uranium. And then for investors that might feel a little more comfortable in this space or want, really like that additional volatility that comes with going a little bit further down in market cap, we do have the Sprott Junior Uranium Miners ETF, ticker URNJ. Main differences between those two products is URNJ doesn't have the physical component. We also take out some of the larger uranium miners. One thing that they do have in common is both funds are pure play strategies, and this is what really sets our uranium offering apart from other investment vehicles you might see. To be included in the indexes, a security has to have at least 50% of its revenue or assets tied directly to things like exploration or mining for uranium. So that's really where investors are coming when they're looking for those pure play strategies.
Well, we're going to have to leave it there, Steve. A ton of great insight. Thanks so much for your time.
Thanks for having me.